This is a discussion about classified balance sheets. On the top of the screen is a balance sheet that is not classified. This is a standard balance sheet. This is the balance sheet for Haley's Gardening at the 30th of June 2017. On the left hand side are the assets, the right hand side are the equities, but we can further improve the quality of information in this balance sheet by classifying the assets and by classifying the liabilities. If you look below at this second balance sheet, Haley's Gardening, same business, same balance sheet, but we have grouped together assets of a similar nature and liabilities of a similar nature to improve the quality of information for the stakeholders. For example, the assets have been grouped under the heading current assets if they are assets that will provide a benefit to the business within 12 months. So the most common example there is bank. Bank is a current asset. It's going to provide an immediate benefit to the business. Stock of supplies or materials is a common current asset because it's going to provide economic benefits within 12 months. It's going to be used up and therefore provide the benefit within 12 months. And then there are other assets classified as non-current assets, and these assets, such as the office equipment, these are assets that will provide a benefit to the business for more than 12 months. Long-term assets. The benefit will be spread over more than 1 year. So office equipment, gardening equipment, work truck in this particular business. These are non-current assets providing benefits to the business for more than 12 months. And have a look at the right hand side of the balance sheet, the liabilities. You'll see a heading there, current liabilities. Current liabilities are those obligations of the business that must be settled within 12 months. And one of the most common current liabilities is the GST that is owing to the Australian Taxation Office. And also loans that are payable within the next 12 months. So in this case, $3,000 is payable to the Westpac within 12 months, therefore it qualifies as a current liability. So current liabilities are current obligations of the business that must be met within 12 months. That's the definition of a current liability. Non-current liabilities is another heading, and these are obligations of the business that do not have to be met within the next 12 months. And the best example is a long-term loan. In this case, there's $11,000 owing to Westpac, which does not have to be met within the next 12 months. It is a long-term or non-current liability. So the balance sheet can now be presented as a classified balance sheet, where the assets are classified as either current assets or non-current assets, and the liabilities are classified as either current liabilities or non-current liabilities. Current assets, here's a definition, those resources under the control of the business that will provide economic benefits within 12 months. And the most common examples we will see will be bank or cash and the stock of supplies. It is possible for GST clearing or GST owing to the ATO or from the ATO to be a current asset as well. That's unusual. But bank will always be a current asset. Stock of supplies and materials will always be a current asset. And non-current assets, these are the long-term assets, that is those assets that will provide economic benefits for more than 12 months. There's a definition down the bottom. Those resources under the control of the business that will provide economic benefits for more than 12 months. Equipment, machinery, computers, all that sort of long-term assets, trucks, etc. Liabilities, current liabilities, those obligations that must be settled within 12 months. The most common examples we will see will be GST owing to the ATO. If the bank is in overdraft, that will be a current liability as well. So bank overdraft is a current liability. And short-term loans that do not have to be settled within that do have to be settled within 12 months is a current liability. And non-current liabilities are those obligations that do not have to be met within the next 12 months, and long-term loans are the best examples. So from now on, balance sheets have to be classified, the assets into current and non-current assets, and the liabilities into current and non-current liabilities.